Saurabh Mukherjea is with us, founder at Marcellus Investment Managers. He's a market master of the day. Saurabh, good morning. Great to have you with us here. Happy Diwali. And greetings of the festive season from all of us here at CNBC-TV18 to you, your team at Marcellus. How are things looking, Saurabh, from an overall kind of market structure point of view? The consensus kind of bet which many are making is twofold. One, large caps are better placed than small and mid caps. Two, financials, which have are the place to be. It's almost like a no-brainer. Do you agree with those two statements, that point of view? Go on.
Saurabh, can you hear me? I can hear you now, Prashant.
Okay, I'll repeat. Let me first wish you a very happy Diwali, Saurabh, and greetings of the festive season. I began with that, so it's good to see you this morning. I was asking you, the consensus in market seems to be twofold. One, that large caps will do better than mid and small caps, and second, financials are the place to be. They're a no-brainer. Do you agree with both those?
I think let me start with the piece on large caps. I would love to say that if I look at, say, consistent compound risk portfolio, which is primarily large cap, I'd love to say they'll do really well. But the thing is, if you look at the setup in the market, the export-centric small caps, companies whose products tend to get sold in the Western world, or companies that are competing with Chinese export, those companies have been beaten up quite badly in the small cap space. So I would say large caps will do well relative to small caps, subject to the caveat, where I think that as the global economy recovers over the next couple of years, companies in IT services, companies in specialty chemicals, pharmaceuticals, which have strong export franchises, I think will see the comeback through 2024-25. That apart, I agree with the core point that we've had a 3-4 year period, 3-year period in India, where, say, just to take an extreme example, an HDFC Bank is compounding earnings at 20-25% year after year, and I think it's barely given any returns over a 3-year period. Similarly, say a Kotak Bank, similarly an Asian Paints, and therefore the point that high-quality large caps are extremely tastily, extremely juicily priced. I would agree with that core point.
All right. Hi, Saurabh. Good morning and good to see you. And in the past as well, you have expressed your view or, a couple of these large cap names. But what's the change you'll have made in the portfolio from the last time we chatted? I recall we spoke about Vijaya Diagnostics. I think you doubled your position in Dr. Lal a few months or so ago. And I think the new addition was Prudent Corporate. Anything post that you'd like to apprise us on, maybe in terms of an addition or maybe a deletion as well?
So let's start with the small cap changes. So now Little Champs portfolio, we've sold Amrutanjan. We sold Amrutanjan through the last 6 or 7 weeks. And what we've added is 3 stocks. We've added RHI Magnesita. I think I spoke about RHI Magnesita a couple of months ago on your channel. And then more recently, we've added a company called PDS. So PDS helps Western retailers, say a Walmart or a Matalan or a Primark. It helps these companies buy apparel from Asia, specifically from Bangladesh. Companies partly based out of London and partly based out of Mumbai. It's been listed for a decade or so, but over the last 3 to 4 years, as China has faded away as a source for high quality Western apparel, PDS with its network in Bangladesh has really come to the fore. So we've added that to Little Champs. In Little Champs, we've also added Cera Sanitary Ware. This is a company we used to own 4 or 5 years ago. Then we sold it. I guess we shouldn't have sold it 5 years ago. When we sold it, we shouldn't have sold it. Company continues to do well, as the name suggests. It's number 2 in sanitary ware in India. I think they've made tremendous strides in their working capital cycle over the last 5 years. I think working capital has shrunk from 110 days to 70 days. It's always been a well-run company. Vikram Somani and family have run it well for many, many decades. But I think startling improvements in efficiency and working capital cycle. And as we get into the more advanced stage of the real estate cycle, we would like to make money rather than buying real estate developers, make money through late cycle plays like Cera Sanitary Ware. So that's the small cap additions. In large caps, in our large and mid cap portfolios and consistent compounders and rising giants, we've also added Trent. We built that position over the last 10 weeks or so. Results have been tremendous, but what's really led us to buying Trent over the last couple of months is the fact that not only has Zudio turned around, we reckon Star Bazaar is also becoming profitable. And all credit to Noel Tata and team. West Side was a known profitable proposition, but to turn Zudio into a high growth engine and now turning their grocery format profitable. A lot of credit to these guys, and we're hoping that trend compounds for us, much like Titan has done over the last 5-6 years for Marcellus's clients.
Well, Saurabh, interesting picks out there that you've taken. In fact, interestingly, we did speak to the management of PDS just last week, and they indicated that they would eye that 5% net profit mark as well, net profit margin mark as well, as they do sourcing as a service. That was an interesting insight that we got into their business. But speaking about Trent, PDS, these enablers of retail, what are your thoughts on V-Mart? That has been your portfolio stock. Second quarter wasn't as good for them. And the management did say that the wedding season hasn't started as well as they would have liked to. This at a time when you're adding other value retailers, Trent versus V-Mart, does it tempt you to perhaps take some off the table on V-Mart or maybe double down given the weakness?
So look, V-Mart's been in the portfolio for the last 4 years or so. And clearly as they've come out of COVID, the business has come out of COVID weaker. V-Mart's business has come out of COVID weaker than it went in. I think this sort of three-pronged challenges here for V-Mart. Part of it is well-run firms like Trent have made a real impact in the value fashion space. By value fashion, I mean the price point around 400, 500, 600 rupees. Firms like V-Mart and even D-Mart really used to have this space to unto themselves. Trent has really made an impact here, as has Reliance Trends. And in addition, I think what they've been impacted by is the online play. The online play has become far more powerful post-COVID. So I think Lalit Agarwal and management are aware of these challenges. They're trying their best to deal with them. I think the last 6 months have seen some signs that they're being able to come to terms with the problem. They've hired some people from other retailers. They've revamped their lineup. I visited their stores in both Eastern and Western India. The V-Mart stores seem refreshed. And we are hoping through the festive season, through the wedding season, we're hoping that V-Mart can get some of the zing back into its franchise. But I agree with you that this was a franchise when we bought it 4 years ago. We had a good couple of years with it, but it's come out of COVID weaker than it went in. And ironically, Trend's success is in part at V-Mart's expense.
Would it then make sense for you to, go the relaxo way on V-Mart as well? Maybe bite the bullet and perhaps look at another opportunities?
So in small cap investing, one learns to be patient. If we sold every small cap and they've had a few rough quarters, then I wouldn't be sitting here. In small cap investing, you learn to realize that companies go through their ups and downs. I'll give you an example, a company that we don't own, but I think a company that's done extremely well over the last couple of years after 9 or 10 years of working very hard. It's LG Equipment. I think I've known LG Equipment for more than a decade. They make air compressors. They put the hard yards in for 8, 9, 10 years. And in the last 2 to 3 years, as in the post-COVID world, they've really come of age as a high-class franchise. So the nature of small cap investing is such you have to understand companies, understand that management teams take a while to fix issues, and persevere with them whilst we go through that.
Okay, I got that. Saurabh, let me just ask you about the financials space, right? What are your thoughts? What's the best thing to own there? HDFC Bank everyone likes as a stock, but it's a very large book, right? 25 lakh crores. Is that? Are there better things to own there? What's the sense?
I think there's two really attractive pockets in financials, and I think there's one area of danger in financials. Just quickly, the area of danger is unsecured retail. We've sort of written a note about it. 10,000, 20,000, 30,000 rupee loans. We think the alarm bells are ringing here. There's significant signs that NPAs and delinquencies are picking up in this space. Thankfully, HDFC Bank, just to take an example, has throttled off on this. So has Bajaj Finance. By the way, all the stocks I'm mentioning are part of my portfolio, my parents' portfolio in Marcellus, and our 10,000 clients' portfolio. So Bajaj Finance and HDFC Bank have throttled off on unsecured small ticket retail lending, but I think there are other lenders out there badly exposed to this, and I think there's a challenge coming here. I think the parts of lending which will do really, really well in the next couple of years is, firstly, I think home loans. I think we're in a stage of the economic cycle in India where even with rates at peak, we're seeing very strong demand for home loans. Over the next couple of years, as interest rates come off, I think home loan demand will pick up. And in that regard, say HDFC Bank's acquisition of the HDFC Limited book, I think will bear fruit, and that's why we're very happy shareholders of HDFC Bank through this whole merger period. Similarly, say Bajaj Finance, which has built a big mortgage book over the last 5 years, I think they too will benefit. I think mortgages, this whole entire middle class India buying their homes, whether we play it through the mortgage lenders or we play it through the construction material companies. I think there's plenty of money to be made there. And the other area is corporate lending. Corporate India's balance sheet is the least geared it's been in 20 years. And I think as we get into the reduction in the rate cycle and a global economic recovery over the next 2 to 3 years, you'll see a real boom in corporate lending.
All right, Saurabh, always a pleasure listening to you. Thank you so much for joining in. Once again, season's greetings to you as well and your team.